How to apply machine learning in stock trading for retail traders. In today's fast-paced financial markets, retail traders are constantly seeking ways to gain an edge. Traditional methods of stock trading often fall short in the face of vast and complex data. Enter machine learning, ML, a powerful tool that can analyze large datasets, identify patterns, and make data-driven predictions. This video will guide you through the process of applying machine learning to stock trading, making it accessible even if you're a retail trader without a background in data science. We'll cover 3 crucial steps: collecting and pre-processing relevant data, training machine learning models, and evaluating model performance accurately. Why use machine learning in stock trading? Before diving into the steps, it's essential to understand why machine learning is beneficial in stock trading. The financial markets generate an enormous amount of data every second. Traditional analytical methods can struggle to process this data efficiently and accurately. Machine learning, however, excels in handling large data sets, finding hidden patterns, and making predictions based on past behavior. For retail traders, this means gaining insights that are not apparent through conventional analysis, potentially leading to better trading decisions and improved financial outcomes. Step 1. Collect and pre-process relevant data. The foundation of any successful machine learning project is high-quality data. In the context of stock trading, relevant data includes historical price data, financial indicators, and even news sentiment. Collecting and pre-processing this data correctly is crucial to ensure the accuracy and reliability of your machine learning models. Example 1. Historical price data. Historical price data is the backbone of any stock trading model. It includes the open, high, low, and close prices of stocks over time, as well as trading volume. This data is readily available from various online sources. Steps. 1. Choose a data source. Websites like Yahoo Finance, Alpha Vantage, and Quandl provide extensive historical price data. 2. Download data. Obtain historical price data for the stocks you are interested in. Ensure you cover a sufficiently long period to capture different market conditions. 3. Clean data. Handle missing values by interpolation or other methods. Remove anomalies or outliers that could skew the model's performance. Example in practice: suppose you're interested in trading tech stocks. You could download historical price data for companies like Apple, Microsoft, and Google from Yahoo Finance. Ensure the data spans several years to include various market cycles. Clean the data by filling in any missing values and removing any days with extreme outliers due to extraordinary events. Example 2. Financial indicators and news sentiment. While historical price data is crucial, incorporating financial indicators and news sentiment can provide additional context and predictive power. Financial indicators include metrics like moving averages, relative strength index, RSI, and Bollinger Bands, which help identify market trends and potential trading signals. News sentiment analysis involves using natural language processing (NLP) techniques to gauge the sentiment of news articles and headlines, which can influence stock prices. Steps. 1. Calculate financial indicators. Use historical price data to compute various technical indicators. 2. Analyze news sentiment. Use NLP tools to evaluate the sentiment of news articles and headlines. This can be done by scoring the sentiment on a scale, e.g., positive, negative, neutral. 3. Merge data. Combine the financial indicators and news sentiment scores with the historical price data. Example in practice: for the tech stocks mentioned earlier, calculate the 50-day and 200-day moving averages, RSI, and Bollinger Bands. Use an NLP library like NLTK or Spacy to analyze news headlines related to these companies. Merge these indicators and sentiment scores with your historical price data to create a comprehensive dataset for training your machine learning model. Step 2. Train machine learning models. With your data collected and pre-processed, the next step is to train machine learning models. The goal is to develop models that can predict future stock prices or trading signals based on historical data. Example 1. Regression models. Regression models are used to predict continuous outcomes, such as the future price of a stock. Linear regression is a simple yet effective model for this purpose, but more sophisticated models like support vector regression, SVR, and neural networks can also be used. Steps. 1. Split data. Divide your dataset into training and testing sets to evaluate the model's performance. 2. Choose a regression algorithm. Start with a simple linear regression and experiment with more complex models like SVR or neural networks. 3. Train the model. Fit the model to the training data and validate it on the testing set. Example in practice, for the tech stocks dataset, split the data into 80% for training and 20% for testing. Begin with a linear regression model to predict future stock prices based on historical prices, financial indicators, and news sentiment. If the model performs well, experiment with SVR or a neural network to see if they provide better predictions. Example 2, classification models. Classification models predict discrete outcomes, such as whether a stock's price will go up or down. Decision trees and random forests are popular classification algorithms in stock trading due to their interpretability and robustness. Steps. 1. Define the target variable. Convert the stock price movement into a binary outcome, e.g., 1 for an increase in price, 0 for a decrease. 2. Choose a classification algorithm. Start with decision trees and explore more advanced models like random forests or gradient boosting machines. 3. Train the model. Use labeled data to train the model and assess its accuracy on the testing set. Example in practice, for the tech stocks dataset, create a target variable that indicates whether the stock price increased or decreased the following day. Train a decision tree classifier on the training data and evaluate its performance on the testing set. If the decision tree performs well, try a random forest classifier to potentially improve accuracy and robustness. Step 3. Evaluate model performance accurately. Evaluating the performance of your machine learning models is crucial to ensure they are reliable and effective in real-world trading scenarios. Accurate evaluation helps you understand the strengths and limitations of your models, guiding you in refining and improving them. Example 1. Cross-validation. Cross-validation is a robust technique to evaluate model performance. It involves partitioning the data into multiple subsets and training the model on different combinations of these subsets. Steps. 1. Divide data. Split the data into k subsets, e.g., k equals 5 for 5-fold cross-validation. 2. Train and validate. Train the model on k1 subsets and validate it on the remaining subset. Repeat the process x times. 3. Calculate metrics. Compute average performance metrics, e.g., mean squared error for regression, accuracy for classification. Example in practice, for the tech stocks regression model, perform 5-fold cross-validation. Split the data into 5 subsets, train the model on 4 subsets, and validate on the 5th. Repeat this process 5 times and calculate the average mean squared error to evaluate the model's performance. Example 2, backtesting. Backtesting simulates how your model would have performed in the past. This helps you understand its potential effectiveness in live trading. Steps. 1. Simulate trades. Use historical data to simulate trades based on your model's predictions. 2. Calculate metrics. Evaluate key performance metrics such as return on investment, ROI, Sharpe ratio, and maximum drawdown. 3. Analyze results. Identify the model's strengths and weaknesses and refine it accordingly. Example in practice, for the tech stocks classification model, backtest the model by simulating trades over a historical period. Use the model's predictions to execute buy and sell orders and calculate the ROI, Sharpe ratio, and maximum drawdown. Analyze the results to understand how well the model performs in different market conditions and make necessary adjustments to improve its performance. Conclusion. Applying machine learning to stock trading can transform the way retail traders operate, providing data-driven insights and predictive power. By collecting and pre-processing relevant data, training robust machine learning models, and evaluating their performance accurately, you can develop strategies that enhance your trading outcomes. Start small, iterate, and continuously refine your models to stay ahead in the dynamic world of stock trading. With patience and persistence, you can leverage machine learning to make more informed and profitable trading decisions. Happy trading!